Welcome, everybody. My name is Michael Chalesos. I am very happy and proud to be the director or coordinator of this RPN, CEPR RPN network on household finance. We are called CEPR RPN. So you hear P twice. So Center for Economic Policy Research and Policy Network. So we have to deliver not only on research, but also on policy advice. And not only do we have to deliver, but we want to deliver. And we have been quite active in organizing these pre-conference policy events the evening before. And the idea on those is to try to combine, to join forces between academics, policymakers and regulators, and also members of the practitioners of the private sector, and try to see whether this interplay can lead to useful suggestions for policy and for practice and for financial behavior of households. Now today, or this evening, we are extremely happy to be talking, to have a group of excellent speakers talking about the unequal personal finance, household finance. I will call it household finance, John. Landscape. John Campbell has given our field its name back in 2006, and I am holding him to it. Our network also has this name. The word unequal, of course, is a very, interesting and deep word. This network, researchers in this network, but also in the household finance field overall, have analyzed different shades of this or sources of this inequality. Several things come to mind, financial literacy, unequal financial literacy among people, unequal cognitive abilities that matter for financial behavior, unequal access to loan products, discrimination is part of this, unequal access to asset products that can be, some of them more complicated and others less complicated, but also less obvious and less direct things like unequal access to informed peer groups from which households can learn. I actually have made the choice that some couples make not to know the gender of the baby before the birth, so I have no idea what they're going to talk about. So which aspect of inequality they're going to talk about. And I share with these couples the excitement and the bewilderment of and the anticipation of what is to come. So let me briefly introduce the speakers. Two of them you know very well from the academic world. You know John Campbell, and you know Tarun Ramadorai, and both have actually been extremely active also with our network and interacting with our network, and they are world-level authorities on household finance. And as I said, John Campbell has contributed really from the beginning to the field. Claire Barrett is a multi-award winning financial journalist, a broadcaster and commentator, the consumer editor of the Financial Times. She presents the EFT's weekly Money Clinic podcast, helping listeners resolve their real-life financial dilemmas. And Kate Collier is the chief economist at the Financial Conduct Authority, heading a division responsible for providing rigorous economic thinking, research, analysis, and advice to help the FCA deliver on its strategic objective of making financial services markets work well. Okay, I have good news for you. I am shutting up now, and I'm listening to these four excellent speakers. And I think John goes first. Is this right? Yes.
Yeah. Okay, well, thank you very much, Michael. And it's really a pleasure to be here at this European Household Finance Group. I've been watching the very interesting conference programs over the years from the other side of the Atlantic, but I haven't had the chance to attend yet. So to be here is really a huge pleasure. Tarun and I are going to do a tag team presentation of a book that we have been writing, and we're just about finished with the first draft of the manuscript. This is the first time that I've ever tried to write a book for a general audience, and every time I try to throw in an equation, Tarun makes me take it out, because we're trying to write in plain English. We don't even have any tables in the book. We have some figures, but no tables. It's intended to be accessible. And our title is Fixed, Our Unequal Personal Finance System and What We Should Do About It. And fixed is intended as a little bit of a pun. We claim that the system is fixed in the sense of rigged or a fixed match, that the playing field is tilted. But we also claim that it's possible to fix it with suitable reforms. So I'm going to lay out the problem, and then I'll hand over to Tarun, who will do the really hard part, which is saying something about how we can solve the problem. But what's the scale of this problem? Our first point is this is global. This is not just about the US or the UK or developed countries. It's a global problem. So the two figures here show the world income distribution as estimated in two different years. The top part is showing you 1975. The bottom is estimates in 2020. And it's daily income per head. The little vertical line is the line of $2 a day, which is taken as the global measure of extreme poverty. And the different colors correspond to different continents. Red is Asia, blue is Africa, green is Europe, and yellow is the Americas. And what you see in 1975 is a very large population concentrated in Asia of extreme poverty. And then you see it's a bimodal distribution. You see a rich world to the right, concentrated in Europe and the Americas. Now, what's happened in 2020, we've seen a tremendous shift in the income distribution with the emergence of a global middle class, much of which is in Asia, but much also in Africa. And really, there's a tremendous number of people in the world today who have fairly recently emerged from poverty and are having a first encounter with the formal personal finance institutions that we take for granted in developed countries. And the problems that we have in our developed country systems are in many ways even greater in emerging markets. So it's a global problem and it needs a global response. At the same time, there are other trends that make household finance just more difficult to do because people live longer, people live in nuclear families rather than extended families, and housing is expensive, higher education is expensive in many countries. So the financing problems are just difficult. Another very relevant fact is that there's a tremendous amount of wealth inequality in both emerging countries and developed countries. This is a figure from the book that just plots the wealth distribution. We're taking the households who have positive net worth. Of course, there's about 10% of households that have negative net worth because they're in debt. But let's put them aside. Let's look at the households with positive net worth, just rank them from the poorest to the richest, and see what we get. And you can see the way in which at the left, we're talking about people in developed countries with a few $1,000s. Over at the right, we're talking millions. And you can see the blue dashed curve is emerging countries. And you can see the accentuated poverty at the left. What you don't actually see very well in the figure is that at the right, it actually converges, but there's a lot of underreporting in these surveys at the right, particularly in emerging markets. But if you start counting billionaires, you'll see that there's a great deal of wealth concentration way at the right in emerging countries too. So inequality is a fact. A theme in the book is that the structure of the financial system and the decisions people make about finances contribute to that. It's not just all about income inequality, labor income. It's also the financial side of things. So 3 relevant facts are that richer people save more on average, that they earn higher average returns on their savings, and that they can borrow more cheaply. And some of that is inevitable and structural, but some of that we feel is the result of problems in the system that can be addressed. Now, this is a plot that shows, gives one reason why richer people save more, which is that they have more capacity to save. So that what the line is showing is the fraction of gross pre-tax income that is spent on non-discretionary items, things like rent, income taxes, debt repayments, and so forth. And you can see that for the poorer people at the left, over 80% of their income is going on non-discretionary things, and then that falls as you get richer. So this is certainly one of the reasons why saving rates are higher among richer people. But we're really focused on another phenomenon, and this is a figure which we constructed from 2 tables in the very nice paper by Bach, Calvet, and Sodini, and I see Paolo is here, looking at rates of return and costs on debt among Swedish households, where, again, the horizontal axis is sorted from the poor people at the left to the rich people at the right. The gray line is the cost of borrowing relative to the risk-free interest rate, and you can see that generally slopes down. The red line is the excess return on gross wealth, on assets, which slopes up. And then the blue line puts that together. That's the excess return on net wealth, incorporating both the assets and the liabilities. So you can see that people at the far left are really not earning an excess return at all over the safe interest rate, whereas over at the right, there's an average excess return that's something like 8% a year. So this is a tremendous contributor to inequality. I'll just show you one other table here on this theme. In emerging countries, poorer people often turn to informal, non-institutional borrowing. So they're not using the formal financial system at all. They might be borrowing from family and friends, or they might be borrowing from money lenders, loan sharks, and so forth. The lines here are showing the costs of these different types of borrowing. The blue curves are emerging countries. The red curves is the US. The solid lines are institutional borrowing costs, and we've just sorted debt from the cheapest at the left to the most expensive on the right, so of course the lines have to slope up. But the point is that the non-institutional lines slope up much more steeply. So you may be able to borrow very, very cheaply from a well-meaning relative over at the left, or you may turn to a moneylender, a loan shark, and you're going to end up paying the rates on the right. And this is true both for unsecured debt and secured debt, but particularly for unsecured debt. Informal, non-institutional borrowing can be incredibly expensive, and this can put people, as you might imagine, into a debt trap. Okay, now one of the themes in the book is that that the starting point of the problems in household finance arise from the difficulty of making financial decisions that ordinary people struggle with. And so we have a chapter that's really about behavioral finance and everything we've learned about financial decision-making of ordinary people. The two figures on the left show statistics on financial illiteracy, or I'll be a little more polite and say low financial literacy, a poor ability to answer questions, very, very basic questions about the financial system. The different bars correspond to different age groups, with the young at the left, the older people at the right. The blue bars are men and the red bars are women. And the dark solid area is, the dark color is the people who are doing very poorly on these tests but are very self-confident in their knowledge. And the lighter areas are the people who do poorly and know they do poorly. And so the message of the figure is there's a lot of low literacy, particularly among younger people, and more among women than among men. But there's also a lot of overconfident people, and men are particularly likely to be overconfident. You notice that those dark bars are a bigger proportion of the total for the men than for the women. Now, this is well known. There's a huge literature on financial literacy. But we go through some of the problems in more detail. We talk about the failure of intuition when you're trying to deal with phenomena like compounding, exponential growth, the challenges people face in thinking about uncertainty, the way they extrapolate from sample averages to population averages, the fact that reinforcement learning learning from your own experiences or the experiences of others, it works very poorly in finance because uncertainty is resolved slowly, and you have aggregate shocks which can mislead you for a prolonged period of time. Social learning is inhibited by the fact that people like to talk about their financial successes, not their failures, and so there's a bias in the transmission of information. And then all of that is sort of cognitive problems, but there's also the problem of temptation, present bias in the academic literature, the role of commitment devices, which can be helpful but are imperfect. So that's kind of a very quick review of behavioral finance, but where we go from that is to argue that people make financial mistakes that then in turn corrupt the financial system. So what are the mistakes? Well, for number one, not appreciating the benefits of certain financial products. You know, what's an annuity? We all know what that is. It's insurance against living too long. But people see it as a risky financial investment and they don't buy it. Misunderstanding the costs of a financial product. Your free checking account, is it really free? Well, no, because if you inadvertently have an overdraft, the bank will charge you $35. They might do that multiple times. Failing to shop around for financial products. Nobody likes to shop for, people like to shop for clothes, but not for financial products. So there's a lot of market power because people don't do this. They go with the first brand, they go with the bank that has a branch on their high street and so forth. And then finally, mismanaging financial products after purchase. Not refinancing a mortgage, for example. If you have, in this country, if you have an adjustable mortgage with a teaser rate, you want to refinance at the end of the teaser period. Does everybody do that? No. Okay, so what does all this lead to? We argue that the existence of these mistakes perverts capitalism in certain ways. I mean, a first obvious point is that capitalists, what do? They respond to the demand for products. Not the demands, the hypothetical demands that people would have if they knew what they were doing and were pursuing their own best interests. So they meet the market demand, but that may not be helpful if people are making mistakes. But beyond that, there's market power. People's reluctance to shop creates market power for firms, gives them room to raise their prices. Of course, it's the usual problem that then you get a lower quantity of beneficial products than you would see in a competitive market. But you also get a wasteful competition. You get excessive entry because financial firms are competing for profitable customers who, once they sign up, are going to be loyal profit sources, and they're not necessarily competing on quality because customers can't perceive quality. Now, sophisticated customers can see through this, but one of the things we point out is that you get then cross-subsidy in the financial system from the sophisticated to the from the unsophisticated, who tend to be poorer and less educated, to the sophisticated. So, for example, my US fixed rate mortgage is cheaper because lots of people don't refinance when they should. They create profits for mortgage investors, and so I get a cheaper mortgage rate. I am profiting at the expense of the people who don't refinance. If you buy a long-term insurance policy, your premiums will be lower because so many people lapse early in the life of the policy, and they create profits to the insurance companies, which are passed on to the sophisticated. And then financial innovation, the design of new products, often is geared towards exploiting these mistakes rather than correcting them. Now, people, have become aware of this. Finance is extraordinarily unpopular. And that's bad because the financial system is important. We need a good financial system, but people have become suspicious of it. And they often seek homegrown alternatives. They might put money under the mattress, poor returns, lack of security. They might borrow from friends and family. That can have very bad side effects if they have trouble repaying. They might borrow from money lenders, high interest rates, the risk of a debt trap, physical danger if you don't pay. Or they may invest in crypto with all the problems that come with that. Crypto, particularly important, for example, particularly popular in the African American community, who is so suspicious of, large traditional white-owned banks, and they think crypto is a safe alternative. Well, it's not. It's out of the frying pan into the fire. So, what can we do to fix this? Tarun will tell you.
Thanks very much for giving us the opportunity to talk about our book. John's taken me out of the frying pan and dumped me straight into the fire here. Let me see what we can do. So, okay, very good. Thank you. So the thing that we advocate to help us build a better financial system is stronger medicine than has been proposed up until this point. And we call it shove, which is in contrast to nudges, which have been sort of advertised as being an important part of the solution, which I'll talk about shortly. But essentially what we mean by shoves is that we should be pushing the personal finance system in the right direction, and we should be unafraid of muscular government intervention to do that. And so in that sense, it is, we're sort of advocating that we should encourage regulators, some of whom are on our panel, and governments to use the incentives at their disposal to reshape the way that the personal finance system operates in light of all of the problems that John has discussed. Now, there's been a lot of focus on nudges, partly because of the book by Sunstein and Thaler on nudge. And so what nudges are libertarian paternalism, which is changing features of the design system to encourage good choices, either in an advocacy basis, so to provide some advice, or to apply these good choices as default, so that when people are inertial about making decisions, that inertia can drive their decisions. So for example, you might default someone into a contribution rate which deducts a certain percentage of income every month or every year in order to put it into retirement savings plans. Now, we are happy with the fact that nudges have received so much popularity, but think that they don't go as far as they ought to in order to deal with the abuses in the financial system the way we see them. For example, even if you just think about advices and disclosures, these are generally pretty weak medicine. When you actually look at some of the ways in which disclosures have improved and information releases have changed because of legislations, for example, in the US with the Card Act, there are very minimal effects on credit card pay down that people actually make. And so people continue to make sort of similar mistakes to the type that they've been making in the past. Even when you change defaults, they're typically insufficient to generate these broad, economically meaningful financial improvements that we seek, So there's this nice paper by Stefano Dellavini and Elizabeth Linos in Econometrica that looks at a large number of different randomized control trials that use nudges and shows that in the real world, rather than in academic studies, the effects of nudges are about a quarter of the published academic studies. And they attribute some of this to publication bias. In particular, there's a difference of, there's a fourfold difference. There's an 8% difference between treatment and control when you look at the field as opposed to academic studies, where they are, on average, finding a 32% difference and a very high effectiveness of nudges. So how do we advocate that this sort of shoving should occur? Well, first, we think that interventions should be well coordinated across regulatory agencies. In some countries, there's a sort of alphabet soup of different regulators. India is a jurisdiction that I'm quite familiar with, where you have the Reserve Bank of India, which is the banking regulator. You have IRDAI, the insurance regulator. You then have a separate capital markets regulator and a separate pension fund regulator. And sometimes they step on each other's toes, or they leave large thickets or large areas which are unregulated as a result of that. And so we think that some coordinated action is required, or even to establish a central regulatory agency of the type that you see both in the US with the Consumer Financial Protection Bureau, or with the Financial Conduct Authority in the UK. We think that interventions shouldn't be applied willy-nilly, but should be limited to poorly functioning marketplaces and financial products. I'll have more to say about that in a second. We believe that households and firms should be actively discouraged from buying and selling harmful financial products and services. And some of the incentives that we think that should be used to encourage both households and firms to do these things are tax incentives. So obviously, households are enormously sensitive and responsive to tax incentives. And so that is one tool that we advocate. Statutory safe harbor provisions, which prevents companies from believing that they're going to suffer from painful litigation and drives out productive innovation from the financial sector for certain categories of financial products that we think should be more widely distributed. We are unafraid of advocating both price and fee caps where necessary, so directly regulating the way that prices are actually put forward to consumers. We also think that there should be some suitability assessments where product suitability should be determined by levels of wealth, income, or financial sophistication. I'll have more to say about that towards the end of this part of the presentation. I just want to make the point that while we advocate forward-looking regulatory oversight to improve incentives, we're not about retrospective punishment, and we're not about direct government intervention to provide financial products. We're not advocating governments as an alternative to markets, just as a way to help markets behave a little bit better and generate better outcomes for consumers than they do right now. Now, all of this sounds a bit vague, and so what we wanted to do is to sort of provide 4 broad principles for regulators and for governments to think about when they're contemplating what to shove. So the first is, we think that one very important way to counteract some of the biases that John's talked about is to fight biases with other biases. So for example, if you think about a prize-linked savings scheme, it counteracts the tendency to not save and to succumb to temptation with a different tendency, which is to be wowed by the incidence of prizes, or to be very excited about having prizes. And so this is an area in which one source of bias can be counteracted potentially with another source of bias. Mental accounting is a very strong principle in behavioral finance and economics, where people have these silos in which they sort of think. And so one of the things that could be done is to essentially directly move income into a separate account. So this is another case in which you can sort of create lockboxes that essentially come from people's tendency to have these little buckets that they compartmentalize their thinking into. We believe that government should clamp down on conflicts of interest. They should instill wariness about the risks of commercial transactions with counterparties that are clearly conflicted, and where necessary, impose fiduciary obligations, which is that, for example, in the financial advice sector, financial advisors should be taking into account customer obligations as if they are their own, and so act in the very best interests of customers when they're making these decisions. And then there's also, we suggest, an important role for making financial products easier to use. For example, in the UK, we have these teaser rates on mortgages where we have a little discounted period where mortgage rates are heavily discounted, and then there's a cliff edge where if you don't immediately refinance into another teaser rate, you get hit with this extremely high standard variable rate. We think that that's precisely the sort of example of a financial product that should be made much easier to use, no teaser rates on mortgages, and also automatic refinancing in that case. So where would we like to go with the financial system, the personal finance system? We want that the system should be essentially have 4 characteristics. It should be simple, cheap, safe, and easy. What we mean by this is straightforward terms on standardized products that can be easily compared with alternatives to enable comparison shopping. Part of the problem with shopping for financial products is that it's very, very difficult to compare different products. And if we can make those things much, much more easily commensurable, then that might actually reduce some of the market power that we've been talking about. Products should be cheap. We should keep costs low, especially for smaller ticket sizes, because for the smallest products, for people who are buying small ticket size products, the fixed costs of product provision means that the percentage cost is substantially higher in those cases. We think the product should be safe, so we should keep products that encourage damaging financial behavior out of the market, or at a minimum restrict who can access them either by wealth or expertise. A classic example of this is crypto. This sort of reminds me of a holiday I took in Greece. Michael and Alex might appreciate this, but I took out my Monzo card, and the clerk at the desk said to me, "Why are you using Monzo? You should be using Revolut because it provides you with direct access to crypto." And I said, "Well, that's why I'm using Monzo." And of course, easy, which is that financial products should be easy to manage after purchase and not require complex follow-on decisions, like having to keep track of precisely when to refinance. Now, at the very end of the book, one of the things that we advocate to make this all a little bit more concrete is that the Consumer Financial Protection Authority in any country should require that any institution offering a financial product in a given category should offer and advertise what we call a starter kit product in the same category, which should be openly available to all, and advertise at hopefully a lower cost than the frills products are. And so these are no frills transactions accounts, short-term savings accounts, small unsecured loans, educational loans with income contingent repayment of the type that we have in the United Kingdom, where you basically don't pay anything until you reach a particular income threshold, and then your income is garnished thereafter. I understand that people talk a lot about the debt of college in the United Kingdom, but the system is better designed here than it is in many other parts of the world. Long-term self-managing mortgages that don't require you to pay costly attention to refinancing. Low-cost index funds. This has been a great success, and it's something that we encourage. Simple term life insurance, not a whole-of-life life insurance policy that doesn't encourage lapsation. We can potentially discuss that in the open discussion. As climate change comes in, automatically triggered catastrophe insurance, which is based on publicly observable events, retirement savings accounts, and we also are big fans of annuitization. So I'm going to stop here, and I look forward to the comments of the other panelists, and thank you very much for giving us an opportunity to talk about this.
Thank you. Well, first of all, that was super interesting, and I was fortunate enough to get a little bit of an early glimpse of some of that. So I'll have an opportunity just to respond a little bit to some of the points that have been made. But first of all, thank you so much for inviting me here. This is my first time taking part with the CEPR, and I'm really pleased to be here, so thank you very much. My name is Kate Collier. I'm the FCA Chief Economist, as per my introduction. Just to give you a little bit of context, I'm sure you know this already, but the FCA is responsible for the conduct regulation of about 50,000 financial services firms across the UK. And we do that in a number of different ways. We authorise firms that provide financial services products. We then supervise them as they're providing those services. And then when things go wrong, we look to take enforcement action so that we can make sure that we have strong deterrents to keep people playing by the rules. Keep firms, I should say, playing by the rules. So what I'm going to talk about a little bit today is some of the ways in which we think about the challenges that have been identified today. I think that the diagnosis that you've given of why financial decisions are so difficult is very clear. And I think a lot of the work that we do in the economics department at the FCA is actually spent in trying to understand some of these issues. We have a behavioural team that does experiments that's trying to understand exactly how decisions can be improved for consumers. So I'll talk a little bit about some of that. I think we also agree, I personally would also agree about the need to think about behaviour and incentives. It seems to me a critical thing for us to understand. And from a regulatory perspective, of course, we need to take very strong account of that. One of the points I think that you've made very clear in the presentation, but I think is really worth emphasising, is of course the outcomes, the impact of all of this depends a little bit on the wider set of choices that are being made, including, for example, government choices. And you mentioned some there, for example, around the funding of education. And I think those are an important thing to consider, and they will be differing from one country to the next. So I'm going to look a little bit about at some of the outcomes in the UK. Just to give it a bit of a grounding in the outcomes we see in UK financial services. And then I want to talk a little bit about the drivers, and I'm going to just zoom in on two particular areas, one being some research we did about gamification and trading apps, which I think exemplifies some of the challenges and the behavioural issues that you've identified. And then I wanted to share some of the thinking that we've been doing about how you think about the complexity of a financial services system. So we've been using systems thinking, which is a technique alongside economic analysis and empirical research to try and identify and explore how outcomes might emerge from complex interactions between lots of different agents within an economy in order to help us be proactive and forward-thinking in the way that I think you're advocating. And then finally, I'm just going to talk a little bit about some of the things that we do at the FCA. And there I will particularly mention the Consumer Duty, which is a piece of legislation that we had put out last year, and which is thinking about how firms should be taking account of the outcomes for consumers and putting the onus onto firms in order to ensure that there are good outcomes for consumers of financial services. So my first point then is just to look at the outcomes that we see in financial services for consumers. As a regulator, we look very closely at this. We monitor the outcomes. We set our strategy in order to try and understand how we will impact those outcomes. And so we pay close attention to them. So these are the key areas that we look at. We mainly use survey evidence to this. We have a large survey that we do every 2 years, financial live survey, and that gives us some good insights into the outcomes that people are getting. We try to look at how that's changed over time, and we try to also look at how vulnerable consumers may be particularly affected and any differences there. So I'm going to just give you a few stats on the key things that we look at for these outcomes for consumers. So first of all, access is a really critical question. Do people have access to the services that they need? We've already talked about the importance of financial services in everybody's day-to-day lives. So from our survey evidence, we find that 1% of people told us they don't have a day-to-day account, and 16% told us that they don't have general insurance, and that has increased over the last couple of years, most likely because of the cost of living squeeze that we've been experiencing, and 20% of people in the UK don't have a private pension. The second question then is, are those products suitable? And to look at this, we use a composite index of consumer satisfaction. It kind of just gives you a sense of people's satisfaction with the products. It's a relatively broadly used measure. And for financial services, from our survey, we find that 7.8 out of 10 is the score for consumers. And that's broadly unchanged over the last couple of years as well. We also look at complaints, which is an important area, and in particular, the uphold rate of complaints when those are put through the ombudsman system, and about 30% of complaints are upheld in the UK. The next area then is, do prices represent fair value? which is a complicated question, and do the quality and benefits that people get from their financial products represent good value? So this is a difficult one. It's obviously quite a subjective question, and there are many different ways you can measure this, but we do try to measure that with a survey. We ask people whether they whether they've been offered a product which they felt was at either prices that they felt were unreasonable or whether terms and conditions were unreasonable. And for that, we found that 10% of people last year said that that was the case for them, and that had grown again over the last couple of years. So there are some questions there about value and benefits. And finally, confidence. So 41% of consumers in the UK said they had confidence, and that's different for vulnerable consumers at 33% and higher, I think, as you'd expect, for people who are not vulnerable. So overall, I think there's some evidence that there are improvements in outcomes over time, but clearly there is scope for further improvement. So I wanted just to next talk about the drivers of some of those issues, and we've touched on these already. We've talked a bit about some of the market failure issues. We've talked about conflicts of interest, misalignment of incentives. These are many of the reasons why we regulate. And as a regulator, I would point to those as part of our existence, not the whole point of it, but some of it. So I wanted just to pick on one particular area, which we've already talked a little bit about already, and that was behavioural biases and our limitations. We're all human. And the one I wanted to pick on was some work that we've recently done, which is about gamification and trading apps. So gamification and trading apps, those may seem like they're relatively innocuous, but actually our research has suggested that sometimes it can play quite a big role in driving poor outcomes for people. So it's important as a regulator that we understand that. And just by way of context, trading apps are important, particularly during the pandemic. They became more and more important. Something like 1.15 million new accounts were opened on trading apps just between January and April 2021, which was almost twice as many as on other more traditional platforms. So it's a really big and growing and important platform issue. And the key differentiator here with these trading apps is that there are elements of gamification and behavioural features which are designed in, and they tend to be sort of aimed at the younger investor as well. So the hypothesis that we wanted to test was whether these apps could be leading to worse outcomes. And we thought about the potential for harm in a number of different ways. So if you think about using a trading app, the way in which you might end up experiencing harm from that could be making an unsuitable choice. So you might end up investing in something which doesn't really match your own preferences for risk-taking. You could end up trading more frequently than you intended to, and we know that trading more frequently can result in poor returns for people, so that could be an issue. And it could lead to at-risk or problem behaviour of the type we might see in gambling. So we looked for those, and we started just by looking at some of the features of some of these trading apps. So I'm going to put some of them up here for you. And I'm pretty sure you'll be able to guess which of the behavioural issues that were mentioned earlier you can see in these. So in the first one, you see confetti whenever you make a trade. You get leaderboards, which give you that sense of really important positive reinforcement when you use a trading app. We also see quite frequent push notifications, and we all know the impact that those have. And there are also quite high default rates, which again have been mentioned, and we know that people tend to stick to the default rates. So what we did was we did a big survey of over 3,000 people. We looked at people who are using lots of different apps and that had different cumulative features in order to try to isolate the impact that these features might be having. And we controlled for their different characteristics as far as we could, and used a gambling severity index score, which we'd adapted for thinking about investment behaviour, just to try and understand how people were engaging with these apps and whether it was affecting these outcomes for them. So let me show you the survey. This is just a bit of information on this, which I'll go jump over. So the results. The first result was that we found that the new apps were associated with investing in unsuitably risky products and that people were trading more frequently. So there is a potential for that to be concerning. We also saw that people trading more frequently, and then we also saw that they're associated with higher levels of at-risk users. So people who, on our index of gambling and potential at-risk behaviour, were tending to use these apps more often. So there was some evidence from this study that we did that there could be an association between gamification and the design of these trading apps and some potential measures of harm. We also found that there was some evidence of behaviour that's potentially problematic, which is similar to the sorts that we see in gambling apps. But importantly, when we looked at the impact, the self-reported impact in terms of losses, we didn't find a significant impact there, but it could have been because we were doing this during a time when market conditions were quite favourable. So it's possible that that was an issue, or possibly even that self-reporting is an issue with this sort of thing as well. So that was one example, but the thing I really wanted just to show you was some work we've been doing thinking about how you consider the financial services system as a system. And this is using the operational research tool of systems thinking, which is a strong and important field in its own right, combining it with economics, where we think about incentives and trying to bring some structure and empirical thinking to it as well. I think this is a really important aspect of what we do as a regulator in order to be able to understand, hypothetically, how it might be that the interaction of complicated and complex agents within a system might play out. So we use this as a tool for thinking about how, for example, macroeconomic events might feed through into outcomes for consumers. We also use it for thinking about how changes in one part of the financial services system might have an unintended consequence somewhere else, because you can't really think about these things completely in isolation. So this is really about conceptualizing markets as systems with different drivers, with different feedback mechanisms and different parties who are influencing these different drivers. It means we try to capture the second order effects between, for example, supply drivers and household behavior on the other side. And we try to think about how all of those then come together and might play out in different ways to help us be sort of forward thinking. So let me just talk through this particular example, and then I'll quickly go through an example in credit markets, just keeping an eye on the time. So here, let me just explain this. So the first layer in this one here is the technological environment. So we're thinking about AI in this particular example. So in the external environment is going to be a number of important dimensions. We've got data access, which we think is important for how AI might have an impact on outcomes for consumers. We've got algorithmic effectiveness, and then the quality of the digital infrastructure. So let's think about that, how that feeds through into the demand side. Household behavior will be affected by those top-level technological environments. So, for example, if we think about algorithmic effectiveness, how might that affect the way that consumers interact with financial services that are using AI? Well, for example, if you have a strong and a good effective algo, then it might be that actually the advice you get is better suited to you and you're more likely to use that service. Data access is important. So young people are more likely to give the rights to use their data. So it might mean that they get a better targeted product for their own personal circumstances and situation. So that might then lead them to be more likely to use the products, and it increases consumer sentiment and demand. Then moving over to the other side on the supply drivers, the important things there when we're thinking about the economic agents that really shape supply, well, government, tech firms and financial services firms, the key things to think about for them will be then the costs and the effectiveness of those AI applications, which might then drive how those firms are thinking about building new products and the kinds of cognitive insight they can get from creating those, all of which then will lead to some of the supply side strategies that firms will be taking. So whether they are, for example, thinking about their pricing strategies and how to adapt those, they might think about how they're marketing products, and there are different strategies that you might use according to the feedback that you were getting from consumers, which is a point that was made earlier as well. So all of that comes together, and the decisions that the supply drivers, the firms on the supply side are making, plus the role of government and regulators, is feeding through then into the impact on demand for new financial services products. And all of that leads then to thinking to the outcomes, which is the bit that we really care about. And we can think about the potentials for the risk of harm, and I'm focusing just on harm for the moment here, but of course we need to think about the important opportunities as well. So it could be, for example, that AI might lead to better pricing, because it means that prices more closely reflect costs, they're better understood. But it could also be that there's an opportunity for pricing to be more using market power and some of the issues that we've talked about before. There's also the opportunity that we might expand access because of the same sort of sets of reasons. Products are more targeted and better, but it could mean that actually consumers don't get the products and some people don't have the access that they need because of the same set of reasons. So this is an example of systems thinking that I just wanted to share to illustrate, I think, the importance of understanding the complexity of the system and thinking about how it all comes together and the potential for unintended consequences. I've got a slide on thinking about this for credit markets, but I'm going to jump past that and move forward into my last question, which is what do we do about it? So we've identified some of the outcomes in the UK that may see some room for improvement. We've identified some of the drivers of some of the harm of that, including some of the behavioural biases, but also more traditionally conflicts of interest, misaligned incentives, market power. As a regulator, we spend our time thinking about what we should be doing about this. And in fact, we have stepped in many different ways across many different markets. We do that through our authorisations, through our supervision of firms, and through the enforcement action. We've talked a bit about some of the markets where there are issues. So, for example, I think there was a mention of debt advice and the conflicts there. So the FCA has stepped in to look at the referral fees that people might take in order to address that potential misalignment of incentives. Also in the overdrafts market, looking there at fixing fees to ensure that people don't get charged for going into unarranged overdraft, and a number of different areas in which we've taken action. But it's good to know. But the final point I did really want to make, and it links back to the point I was making about systems thinking, is that we last year introduced the consumer duty. So it's really important when you take that system perspective to think about outcomes, and the consumer duty is an outcomes regulation. So last year, in 2023, Parliament asked us to introduce these rules, which had cross-party support, and it's rapidly become one of the most talked about bits of regulation that we have. And at its heart, what it's doing is setting higher and clearer standards of consumer protection across financial services, and it requires firms to put consumers first, which sounds simple, but in practice is actually it can be quite challenging to think about. And because it's an outcomes-based regulation, it's really thinking about how we make sure that the system is working in the interests of consumers, in the interests of firms, and in the interests of the wider economy as well. So the idea with this, and I think it is consistent with some of the points that have been raised earlier, is to give firms the space to really create the right environment for consumers and for innovation as well. So using the market set of incentives to make sure that we're really giving space for that to happen. And the early signs are that actually there have been some improvements in some of the markets and that firms have been taking that. So firms have been asked to have a board champion to look at the consumer duty, to make sure that they've reviewed their products, to think about putting the consumer at and the consumer interest first. And there are some early signs that that's actually leading to action and that there are positive steps being taken. So, in conclusion, I just wanted to say thank you. I really did enjoy the excerpts that I got to read. They were very thought-provoking. I hope I've shown a little bit about how we as a regulator in the UK are thinking about how we address some of these challenges. I'm interested in talking a bit more about the proposals that you've made with your book. And in particular, I'm interested in following this theme of the sort of dynamics of a system and thinking about how, when you think about some of the suggestions that you've made, you would manage the risk of unintended consequences and make sure that those dynamic incentives are not blunted, because we know that dynamic incentives can be so critical. Innovation, new entries, really critical to really driving good consumer outcomes. So interested when we get a chance just to pick that one up. Thank you very much. Fantastic.
Okay, you'll be relieved that I don't have any slides because my phone got stolen on Monday, which has upended my entire week, so I didn't have time to prepare any, but I might just make that disappear because it sort of frightens the pants off me somewhat. Brilliant. Okay, well, I'm Claire Barrett. As you know, I'm a consumer editor at the FT. I don't just work for the FT. FT readers are wonderful, but most of them are very wealthy, and we're here to talk about the huge inequality that we see in the financial system, and not least in the world around us. And in my job, I would say the absolute best aspect of it is that I get to speak to people like you, to consumers every day, whether that's through people emailing me, ringing me up because I do things on LBC radio, currently with Nick Ferrari in the morning, so you know I'm spanning all political spectrums as well as income ones. And I'm on ITV every Wednesday with Lorraine Kelly on The Lorraine Show, which means I've got a lot of fans who are older women in their 50s and 60s who send me lots of lovely, encouraging messages on Instagram, often because they're very frightened of interacting with their finances. They find finance something that's very scary and intimidating. And the thing is, it's not just women in Britain in their 50s and 60s who can find personal finance intimidating and scary. Actually, there are an awful lot of FT readers working in the financial world who tell me privately that they feel exactly the same, except worse, because they've got that added imposter syndrome of being somebody who works within finance yet doesn't know all that much about the personal finance aspects of this. I'm seeing nods, and I'm really, really lucky that at the Pink Paper, where I've worked for over 15 years now, they believe me when I tell them, actually, you know, there is a need for financial articles that explain and decodify, defang, dejargonise the financial world. One such article I've written in the last 6 months was, in fact, all about the consumer duty. What is it? Because for ages it was like, this is something that's coming up in the pipeline, and I don't know if this is being broadcast, but firms were literally, shitting themselves about this legislation for months and months and months. But how would it be implied? Putting the consumer first. It's almost like many of them had never had to think about this before, but ironically the consumer was kind of like one of the last people in the room to actually find out that this frankly fantastic legislation was coming our way. And I would go further than you, Kate, and I would say the benefits actually are really, really apparent in all spectrums of the financial world already, even after coming in for barely a year. You've got really big financial advice firms like St James's Place, where wealthy customers are saying, well, hang on a minute, we've been paying for an advice fee, but we haven't necessarily been getting an appointment with an advisor every year. That's caused huge problems at that firm. They've had to set aside millions of pounds to do it right. If anyone here drives in London, I know we're becoming a small minority now, and probably rightly so. You've got all of these problems with car finance, which again the FCA has gone back and is historically investigating whether people who were sold these PCP contracts on their cars actually had this unfair advantage of commission basically being applied to these contracts on a whim. If you walked into a car dealership and you look considerably richer than Yao, as Harry Enfield might say, would the car dealer think, oh, well, if I ask this person if they'll sign a contract at 7% interest instead of 4%, might they say yes? And, it's brilliant that this is all being exposed and that companies are having to account for this. We'll wait until September to see how much money people might get back. So, in summary, I cover the full spectrum of people, from those with very little money to those with a lot. And I'm also really happy to be here talking to you today because I am a Queen Mary and Westfield graduate. I graduated from here in the year 2000. I still live locally up the road in Hackney, which is where I lost my phone on Monday. And I was just thinking on the way here today, like when I graduated, I did a master's degree for a year as well somewhere else, but when I left Queen Mary, I had £6,000 in student debt from the student loan system, and I had a £2,000 overdraft, which seems like a pimple compared to what students today, including my own stepchildren, are graduating with. I was able to clear that relatively quickly while I was working here, because I'd worked before I came to university. I had a job paying me £10 an hour. I was working in Canary Wharf as a secretary to the publisher of a property magazine, which I later ended up becoming a reporter on, so that was quite a bit of good luck. Graduate salaries on the whole now are not that much higher today to when they were when I graduated over 20 years ago. The level of debt that young people are leaving university with is huge. The amount of money that people are having to save up before they can get on the housing ladder is so huge. I don't mean to depress you and tell you things that you already know, but if we're gathering here under the banner of our unequal personal finance system, then this is the nub of it, the intergenerational equality that's building up. The rise of the 40-year mortgage, all of this financial engineering that's going on to give younger people access to things that were once taken as read. If you were a middle-class professional, of course you would be buying a house. I bought my first flat say first flat's the only one I've ever lived in, up the road at the age of 26. Now, would I be able to do that as a 26-year-old graduate on an entry-level salary today? No, of course I wouldn't. But people need somewhere to live. People are delaying family formation. Our population is shrinking. How on earth we're going to pay out the state pension out of the national insurance contributions of everyone when that happens? These are problems that politicians today, frankly, just aren't discussing. Now, your ability to get on the housing ladder today, or even frankly rent somewhere decent on your own, is largely determined by one thing, and that's your parentage. How much wealth there is in your family. We've turned into what some call an inheritocracy or a gerontocracy, which is a society governed by the old boomers, as people say. I did get called a boomer the other day, and I thought, I'm only 47, steady on. But it has become an insult because of the huge rises that we've seen in the value of houses, and those who've got one and who can pass on the equity to it or use equity release and get it out sooner than they might otherwise have done, and those who are having to work, graft, borrow increasingly for 40 years at a time, face a payback window on their student loans of 40 years also, and then hope somehow to save something up for retirement on the side. So, that really, to me, is one of the biggest inequalities. Also, we have the male-female equality, which I think we can discuss more on the panels. It was addressed in one of the slides on your book. Confidence is a really, really massive factor in that. Obviously, there are structural issues too, the gender pay gap, the gender pensions gap, which we'll get into. But I want to focus a little bit on confidence, because confidence is something that I really try and give consumers who listen to me on the radio, on the TV, explaining things in simple, jargon-free language, giving people the facts to which they can go away and make an opinion. Now, we've heard terms and conditions mentioned quite a few times today. Now, one of the great things that the Consumer Duty has been doing in the UK is to really make firms look at the stuff they're bamboozling consumers with, the journeys that we're having to take as customers when it comes to buying a product, being able to understand it, compare it with products from other providers, because certainly there are lots and lots of companies that exist to help us shop around, but not very many people, or not enough people, are using them. We've also got this problem, I think, of a huge level of financial inertia on behalf of consumers. Now, it's hard to say academically, statistically, what leads people not to make a decision, but I do think it is overwhelm. There's just so much going on in people's lives. If they're told that they have got to pick one of 5 different investments, the chances are they'll just leave their money in cash because they won't feel capable of making a decision. So this idea of the nudge, the shove, is definitely something that I'm broadly in favour of. Now, when I graduated, went into my first job, the pension system was very different than it is now. This is one thing that you have got that is better, so good news coming up. We now have a policy in the UK called automatic enrolment, which means if you start working for an employer, providing you're over the age of 21 and you're earning more than about £12,500 a year, you will be put into the pension scheme automatically, unless you say, I don't want to be in it. And surprisingly, quite a few people do object and come out. But that's something that cost me money, because I just didn't know about it when I started work. Somebody well-meaning called Dad did of course tell me about it, but it didn't explain it in a way that it made sense to my young mind. Now, I've written a book, it came out a year ago, called What They Don't Teach You About Money. Does what it says on the tin. It's aimed at younger people, because frankly, you don't have the capacity to make as many mistakes with your financial lives as my generation did. And obviously making mistakes is one of the best ways of learning, but better to read about mistakes that others have perhaps made in order to ensure yourself. I've rebranded pensions in this book as free money. That's a concept that people sort of have a natural curiosity about and want to learn more. If you pay in, your employer has to pay in, and the government also pays in the form of giving you tax relief. Now, you mentioned tax incentives. I think the tax incentives on pensions are very poorly understood in this country. Just as those with more money get to borrow at lesser rates, people who are earning more money tend to have a bit more savvy about how they can get the most out of different tax reliefs within the system. Now, it's not tax avoidance or tax dodging. It's making use of something that is given to everyone. Obviously, the more money you have, the more of a surplus you might be able to generate to put into savings and investments. But nevertheless, explaining the basics is something that we really need to do. Now, what they don't teach you about money, a very good question asked to me at the first ever event I did about the book, was who is they? What they don't teach you. Now, the obvious answer is schools and the education system. We don't have a proper mandated personal finance education programme in the UK. There's bits and pieces. It's sort of on the national curriculum in name, but there's no exam. Academies don't and private schools don't have to follow it. So it's very much up to the individual schools. The Financial Times has set up FLIC, the Financial Literacy and Inclusion Campaign. We're trying to make it easier to teach the teachers, because often the teachers are not confident about finance, and give them all of the materials and lesson plan information that they need. But also, crucially, I mean, I say I wrote a book about finance. I never wanted to write a book about finance because I think that books are very much part of the last century. Certainly I was forced to read many when I was studying here for my degree. But how young people learn nowadays, I think, is not about books and reading. Even this concept of financial literacy sounds a bit old hat. We watch videos. I say we, okay, I'm not young, but I make videos because that's the community of people that I am looking to target. I look at my own children and see, well, I'll tell you a rude story. Years and years ago, I caught my youngest stepson with a spliff, a perfectly rolled spliff, and I said, "How did you get this? Has your older brother been doing things?" And he said, "No, I learned how to do it on YouTube." Now, this was years and years and years ago, but the penny dropped. And I thought, you know, these kinds of things, you know, these codified, secrets between generations, whether it's to do with wealth, you know, or dope smoking, frankly, you know, there's this short circuit now. You don't have to have somebody in the know telling you about this. You don't have to be able to afford an FT subscription to read about finance. You can look at it on your phone, on YouTube, on TikTok. Obviously, and I'm sure we'll come on to this in the panel discussion, you're going there to learn. You don't know whether the people who are teaching you the stuff are the right ones or not. But what gives me strength and encouragement as a journalist is that there's a huge appetite from people, younger people, to learn more about finance, to learn more about investing, to learn more about careers and how they can boost their earnings power, how they can get a side hustle, tax on side hustles. I mean, who thought that that would be the story of the year in January and February when HMRC appeared to change the rules? But you know, people are a lot savvier, I think, than we give them credit for. But we could do a darn sight better than we are at the moment with just teaching people the basics, and also letting that knowledge and that quest for financial knowledge continue. It shouldn't start and end in schools. I'd like to see a lot more financial education going on at university level. That's, you know, a situation where people are often encountering, you know, debt and having to manage living costs, living away from home for the first time, but also in the workplace. The best workplaces, you know, the workplaces where we're making our wealth, we're paying into our workplace pension, often the time, you know, we're thinking about different progression within our careers, often thinking about retirement. There are lots of very forward-thinking firms who are doing lots of, they call it financial well-being, that's the buzzword, for their staff. I don't care about the buzzword. I think actually that the outcomes are good because there are lots of surveys that show us that employees worrying about money is actually one of the major causes of the loss of productivity amongst workers. So I will shut up shortly because we're going to go and sit on the panel and talk about some more of these things in detail. But I mean, my focus for you younger people in the room who might be feeling a bit depressed looking at all of this is focus on what you can control. You know, compounding is a wonderful thing. Even if you're starting off with very small amounts on your investing journey with your ISAs, with your pensions, you know, be as tax efficient as possible. It's not difficult to find out information about these things, and be aware that even quite small sums but invested consistently over a long period of time can add up to something much bigger. The choices that you can make, your choice of career, the company that you work for. One company might give you great pension benefits, another might give you the bare minimum, but the only way you can find out about this stuff is by asking at job interviews, because companies aren't, you know, they're not made to publish these things. That's one regulation that I would, frankly, bring in. And then also keep on learning. I've talked about, you know, how we all need to keep learning about money throughout our lives, but frankly, any skill that you can pick up. Now, I didn't think when I left Queen Mary, I mean, I really wanted to be a journalist, and I did write for Cub, which was your newspaper on campus at the time. Did some salacious stories about how to be a squatter and other great money-saving topics. But I didn't ever think that I'd be, you know, a video editor or a TV presenter or somebody who was a public speaker. You know, these are all skills that I've picked up along the way. And one of the main ways that I've done that is through networking, you know, by being present, by coming to events, by coming to things like this, by harassing people, following them on LinkedIn, saying, can I have a virtual coffee with you? And I would say, you know, that's one of the biggest levers that you, as, you know, young people, academic students in the world can pull to get on going. And finally, take a leaf out of my book as a financial journalist. I've never been afraid to ask questions. And I think that that's the biggest single superpower that journalists have. But really, it's a confidence thing. You know, we think, well, it's our job to ask questions, so we should. But I think everyone's personal finances in this room, my own included, can definitely be improved by asking more questions, not fewer. And the great news is that when the panel sit down, we're going to have a little conflab amongst ourselves for about 15 minutes, I think, and then we'll be taking questions from you. So I expect to see lots and lots. Thank you very much. Shall we sit down? I would say thank you very much for your great presentations. I mean, I think that the theme of all of it really was the consumer. You know, you're looking at the consumer from, you know, perhaps a more academic, more global standpoint than I have imagined things by. But I suppose the topic that I'd like to get into the most is this issue of fairness. You know, we're sitting here under the banner of inequality. Now, the way that markets are structured, where you often have one group of people who can get a better rate if they choose to, and another group of people who, for whatever reason, are denied that better rate. Now, wanting to make the financial products marketplace a more level playing field is a very noble aim, but I am sitting there slightly selfishly thinking, well, as somebody who has a good credit score, you know, should I not be able to get access to a better mortgage rate? You know, in a fairer world, yes, I would be paying a bit more, but, you know, does my good behaviour need to count for something? You know, it's very hard to squeeze out these feelings of self-interest, but I thought, should we come to that first? Because I know the FCA's done an awful lot of work in different areas in the UK, like overdrafts and the insurance world, to try and address that basic question. But for me, that was the big takeaway. Do you want to go first? Or?
I'm happy to. I think it's important to distinguish inequality and fairness. So some inequality is inevitable. For example, if there are fixed costs of providing financial services, then proportionally a small ticket, you know, a small account is proportionally more expensive to provide than a big one. And a small loan will have greater costs of origination relative to the size of the loan than a big one. And so we should expect that people who are doing things on a small scale are going to pay higher costs. And we can't just wave a magic wand and make that go away. It's also true that people who've started life with a lot of bad shocks, bad luck, maybe some bad decisions, are going to have a low credit score. And they're going to have to pay up if they want credit. And in fact, we think that having accurate credit registries, records, so-called digital footprints, is pretty important for the financial system. Overall, it's going to increase credit availability. The more accurate and comprehensive those records are, the more credit will be available. But of course, there are going to be people who have had some bad luck and get a very bad credit score, and it's going to take a while for them to recover from that. So there's going to be some inequality there. We don't think that you can eliminate all of that. But where we think we need to work harder is to create financial products that are just easier for people to use. We want to squeeze out the unnecessary mistakes. And we particularly want to squeeze out the products where sophisticated users get actually cheaper, even cheaper products because of the mistakes of the unsophisticated.
Okay.
So, the teaser rate on a mortgage is lower because some people don't refinance when they should, and they pay the standard rate, which is sort of a rip-off rate, and those cash flows come into mortgage lenders, and some of that gets passed on to mortgage borrowers upfront in the form of lower rates. And to us, that seems like not only inequality, but also unfair and unnecessary. If we can design products that are easier to use, I mean, the equivalent in the US is the refinancing of fixed rate mortgages. And fixed mortgage rates in the US are lower because not everybody refinances. There's a lot of racial inequality there. Minority borrowers pay more when rates have fallen by as much as 50 basis points on their mortgages because they're paying old high rates and they could be paying lower rates. So we think, it's not that we're going to eliminate all inequality, but let's do what we can to make a simple and therefore more fair financial system.
Okay, well said. And Kate, I'll come to you next because we talked about mortgage rates there. Savings rates are perhaps another comparison, but it was the FC's work intervening on overdrafts more recently where I felt it crossed a line, the cross-subsidisation of how the customers with the lease were really paying the good rates for the people with the most. But tell everyone a bit more about that, perhaps.
Certainly. So overdraft fees, it's a service that some of us need to use from time to time. Unexpected expenses that come out of our current accounts, and you get charged a fee. So one of the issues that we saw is that there were quite large fees being charged to people, particularly people who were using them again and again, and going into the unarranged overdrafts were paying quite large fees in that. So we took steps to get rid of fixed fees. So the upfront payment, you go in to your overdraft by just a penny and you get hit by a fixed fee. So we stopped those fixed fees and we asked that firms look at when people were using repeatedly using their unarranged overdrafts. And we recently did an evaluation of that, which showed that the cumulative impact of that was really, really quite significant, those steps. It had a big impact on consumers. I think it was something in the order of £500 million that were saved by people as a result of those relatively straightforward steps. Another example of that perhaps is thinking about some of the loyalty penalties, and financial services are by far from being alone in featuring some of those. But we looked at loyalty penalties in insurance products as well. Where
this is where you're with one firm.
Yes.
You could change, but you don't. You just accept you're defaulted into continuing at a price walking. I think
price walking was the term. It's quite evocative, isn't it? So the idea being that you get a good introductory rate, and it's probably really very good, But if you don't then change the look around and search and switch at the end of your renewal period, then your price will potentially increase and increase. So that was another area where we stepped in just to ask firms to look at how those prices were being set and think about that. But just coming back to the consumer duty, I think that is also a real opportunity to think about how we ask firms to take those steps and to think about the information that they're providing to consumers, for example. Is that being explained clearly? We've seen examples of firms putting out videos to explain policies, because that is an easier way for people to understand some of the terms and conditions, that word again. And some of those things can be quite effective, and we're seeing some quite interesting and innovative solutions in that space, which I think is quite encouraging, as you said, Claire.
Yeah, well, I'm a big fan of video, full stop. But I'll turn to you, Tarun, because it does get to the point where you think, like, okay, another area that we talked about there was high stakes trading. Trading contracts for difference. I hope nobody in the room's ever done it. But if you have, or written articles about it, gone onto one of the websites of the CFD traders. This is a very high risk form of making bets on movements of share prices or other market indexes. Sometimes you can borrow money to amplify the power of your bets. Now, it is quite strictly regulated, but nevertheless, all of these providers in the UK at least have to say how many people who use their CFD services lose money prominently. There's one such provider I was looking at last week. It says 81% of people who use contracts for difference end up losing money. And yet people still go ahead and think that they can beat those odds and beat the market, perhaps because they think it's the only way that they can amass a housing deposit if they haven't been born into a wealthy family. But nevertheless, how much individual responsibility should we place on these things, and how much regulatory responsibility should there be? Because these firms would say, we're not doing anything wrong, we're making the risks clear, but yet harm could still be done.
Just as we made a distinction between inequality and fairness, I think it's also important to understand whether you're taking on compensated risks or you're being pushed into risks that are, you're extracting compensation for people for things other than taking risk. So let me try and be a little bit more specific about that. I think all sort of feel, if we've been working in finance for a while, that if you are going to get rewarded, you should get rewarded on the basis of the risks that you take for your on the assets that you invest in. And that if you are paying rates on liabilities, it should reflect your probability of default in your conduct. And so your example of, I've spent my time sort of trying to be a good citizen and I have a good credit rating, absolutely that kind of behavior should be rewarded. I think the point at which you sort of cross the line is there's sort of two things. The first is there's this kind of notion of mens rea in the law, which is, do you really know what you're doing? Do you have an ability to understand precisely what you're doing? And in some of these cases, people don't understand. And in those cases, there are clear abuses. For example, I remember quite clearly going up and down the tube, and there were all these ads for Shiba Inu, which was this crypto based on a dog, right? And so when people are sort of looking at this stuff when they're going up the escalator, they think, wow, this looks great. Elon Musk is recommending it, or whatever it might be. There's this sort of Doge coin or whatever it is. And so those are cases in which you're being pushed into taking bets that you don't believe are risks, but are actually risks. That's a clear case for intervention. And that would be a situation in which I think we'd have no hesitation in advocating a shove. But those boundaries, I agree, are important. Sometimes people are going to lose money because they take on financial risk. That's fine. Consenting adults should be allowed to do that, and we're not about to regulate that kind of thing. But there are these cases in which, first of all, do you know what you're doing? There are abuses. For example, in the case of overdrafts, there was this big case about how they rearranged your transactions during the course of the day by moving the timestamps around, so that they would always charge you an overdraft fee because they would put the debits right before the credits, so that you'd be paying a $35 overdraft fee because you went into overdraft because the credit was sort of processed a bit later. That's another clear abuse which was clamped down on. The other thing I'd just say is I'd sort of reiterate the point that John made, which is I think transfers are really problematic. Cross subsidies are really, sort of irritating because that's a case in which the product design is a problem. In many cases, the product has been designed. For example, my former colleague David Miles talked about this issue of the teaser rates when he wrote a report for Gordon Brown in 2004, and about how he thought that the reason the teaser rates existed was to part forgetful people from their money. We just published a paper last year, 20 years later, that used the data from the FCA to show that those transfers are still going on. And I know Joao has a paper on this as well. So some of these abuses are ancient. They clamp down on forgetfulness. They affect particular groups of people. Those are the situations in which I think we'd be very happy to advocate muscular government intervention.
There's two very obvious areas where financial market regulation haven't reached, which I'm sure probably affect the daily lives of people in this room very much, which of course are cryptocurrencies, which we've spoken about, still very unregulated, although parts of the institutional world are getting more interested in crypto. And then the other one is buy now, pay later. I mean, I didn't know. I normally shop online where buy now, pay later, you're just offered it. I didn't realise that you could actually get it in shops until I took my stepdaughter to Westfield Stratford City a couple of weekends ago. And, we were in clothes shops and being told even if you pay at the till, you can now pay in 3, make it easier to spread the cost of purchases. And I have very mixed feelings about buy now, pay later because in a cost of living crisis, right, if you can spread the payments and it's interest free, then obviously it's a lifeline for people who are able to manage those payments responsibly. But it is also, particularly for younger and more vulnerable consumers, a massive temptation. A word I think that you used in your part of the presentation, John. Now, buy now, pay later. It's not a UK specific phenomenon. It's in the States. It's in Australia. But it just strikes me as crazy that we're not clamping down more on those kinds of risks in the system.
Yes, I see my colleague Emily Williams is here, and she's written about buy now, pay later, and I think, one of the things we say in the book is that we want to make the provision of short-term unsecured credit linked to your income rather than your spending desires. So, payroll advance products, which essentially mean that your paycheck is more flexible in its timing and it comes through your employer. We're much more in favor of that than buy now, pay later, which is, tempting you to make impulsive purchases. Now, to some extent, the rise in interest rates is going to help choke off buy now, pay later because it's much easier for the merchants to offer a zero interest credit when the interest rate, in the economy is very low. But we don't think that buy now, pay later is necessarily something that's so wicked that it should be forbidden. I think it's a troubling development. It can be misused, certainly, but we're more about encouraging the more responsible forms of credit than anything else. Crypto, I think crypto there's a sort of slow motion spread of regulation. I think, the SEC and Gary Gensler was obviously just dying to regulate crypto. The political environment was unfavorable. The FTX collapse gave them some opportunities. They're making a move. But of course, Bitcoin's gone up again. So, maybe the next wave of regulation will be when the Bitcoin price goes down again. That's when the political stars align. But I would expect over time that crypto will get gradually more regulated. That would be my guess.
Yeah, certainly it's definitely feeling more like a regulated product. The advertisements that you mentioned, the other ones that were on the side of a bus saying, if you see crypto on the side of a bus, it's probably time to buy it. I mean, it was just like an aberration that they were allowed to.
My
exist.
favorite ad that I saw in London 2 years ago was from Coinbase, and it said, "Millions of Brits understand crypto. Do you?" And I thought to myself, I don't understand crypto, and I bet millions of Brits don't.
I think what they do understand is the dream of get rich quick.
Yes.
You know, it's a few lines of code with a dream attached. That's the definition I came up with under duress at a recent panel. Because if you've got to come up with a capital sum of, you know, 50, 60,000 pounds to get on the housing ladder, and somebody says, oh, well, you know, I put £1,000 into Shiba Inu, or whatever it is, you know, you have got people walking around who have made significant amounts of money from it. So it's quite difficult to rail against that.
And those financial promotions are now being looked at and regulated.
Yes, and I think that with all things that sort of occur in the tech world that are sort of like in the digital space, you know, whereas the regulation may be sort of slightly analog, you know, there has been this gradual adaptation and clamping down of some of the worst excesses, and certainly with the crypto exchanges, the ability to leverage your trades, you know, to borrow money, to ramp up the level of risk, you know, that's something that has been clamped down on, even though the actual asset class itself is unregulated. Shall we talk a little bit about gender before we go to questions in the room? I mean, we are talking about financial inequality. You know, your very first slide, I think, about the confidence levels of women and men when it comes to feeling about, you know, able to make decisions about financial products. I mean, this is something that comes up again and again, and I have to say, as a journalist, a female journalist, you know, it does really annoy me sometimes, because I think, you know, it's kind of making out that women are somehow stupid, when a lot of surveys show that when women do invest, we tend to do better, but it sort of takes us a longer time to feel confident or wealthy enough, perhaps, to be able to do it. But give us your thoughts about the great gender divide when it comes to financial inequality, and we'll hear from John and Kate.
Sure. I mean, there's a sort of early paper by these guys, Barbara and Odine, which is called Boys Will Be Boys, Gender Overconfidence in Financial Investments. I think that's sort of it. And it's a great paper, because what it does is it's one of the earliest papers to take brokerage data and look at the trades of different people using different channels. And what they find is that the people who trade the most overall are the ones that make the lowest net returns, because they squander their money on transactions costs. And if you rank these people, essentially the ones that are the very worst are single men trading over the internet. Right. And the very best are married women who trade over the phone. Right. And it's basically because of the fact that, first of all, there's overconfidence that makes them sort of respond to their thoughts about whether something is a great investment or not. So men just trade a lot more. And the second thing is that having the additional latency of having to pick up the phone and take that extra second before you initiate the trade actually really helps people. So sometimes frictions can be extremely helpful in this process. Now, there's sort of two sides to this. On the one hand, you know, a lack of confidence can be a reduction in overconfidence. And that's very good, because what that means is you're not going to make stupid decisions. And so I think there's this sort of idea that, but there's a sort of a dark side to this as well, which is a lack of confidence is just a lack of confidence. And what it then means is that you've been told, or the entire system is gendered in such a way that you've been told from a very young age that certain things are not your area of competence, and the competence is sort of all concentrated in one gender rather than the other. You know, you sort of get these situations where there's a sort of learned helplessness associated with making financial decisions because of the way that the system's been set up. I think, you know, this is something that we're very aware of, and it's certainly something that I think we ought to say more about in the book. And since it's still a work in progress, I think we'll talk more about that too.
I mean, it's very striking to me as a reporter how many you know, internet-based and events-based, networking-based groups that there are for female investors. Now, you almost think, why isn't there something for men? You know, you've got girls that invest, female invest, VestPod. You know, these are all great sources of, you know, financial education and empowerment, you know, a word that they all like using. But give us your views on this case as fellow women on the panel. Do you also get annoyed about this stuff?
Well, I mean, yes. I mean, we find these frictions in lots of different parts of our lives, and it's certainly something that I think plays out in the use of financial services. The perhaps ray of hope that I might offer, because I think we should be looking for those as well, is that perhaps technology might be part of the solution here. Because when you look at some research that we've done thinking about the role of robo-advice, so this is kind of slightly automated advice, but it can be a really important and valuable source. We see that women might be more willing to take advice, and that can really help in terms of making decisions, and particularly some of those bigger decisions where the long-term cumulative effect can be quite significant. So maybe technology could be part of the solution for some of those issues as well.
It's a really good point, because there was a point in, I think it was in, whose presentation was it in? It was in your presentation, where you said that younger people were more prepared to submit their data. So I get asked a lot about apps, because lots of my readers, certainly the FT ones, are cash-rich, time-poor. You know, they've got money, they want to invest it, they don't have the time to think about where, the how, the why, etc. There's this very popular app that will use open banking. Does everyone know what open banking is? Where you consent to share your financial data with an FCA-approved third party, and they can then give you insights leveraged on that data that could save you money. So there's one called Emma, which you've probably heard of. Interesting that they chose a woman's name, I thought, for that. I love the fintech world, because they're always going after niche markets. There's a similar one called Chip. Chip is a bit more of a shover than a nudger. So and there's another one. The name I'm struggling to recall. Sorry, perimenopause. I'll get there in a minute. But anyway, this particular app, the name of which I can't remember uselessly, it will go through and it will say, you know, this direct debit is a mistake. You know, you should cancel that. You know, why are you spending £200 a month on Ubers? You know, it will give you a real sort of ticking off financially to shove you out of these decisions, and it will do it very, very quickly. Because the really striking thing for me about AI is the speed. You know, if you've ever used any of these generative AI tools, although the information might be a bit woolly, you know, the speed at which it can come up with it is the really is the really shocking thing. So I mean, some of these apps and nudges could be a good way for people to become more savvy.
So let me just bring up a slightly different angle on the gender issue. I mean, I think in many financial contexts, both shopping around and also perhaps negotiating with providers can be very important. And I don't know of research, I'd love to, if anybody does know of research, I'd love to hear about it, as to gender differences in the willingness to shop in the financial context. So men might be, on the one hand, more comfortable with finance, more willing to sort of look around, but on the other hand, men might be, you know, hasty, overconfident, just go with the first thing they see. I just don't know, and I think it's an important question. There is some evidence on negotiation, and these are old papers now, but there were some very notorious papers about car dealers in the US. This is Ayers and Siegelman from the 90s. And what they found, they did an audit study, and they trained car buyers, sent them out. They had white men, they had white women, they had black men, they had black women going to car dealers. And what they found is that the white men were offered better prices, and then all the negotiators had been trained to follow certain pre-planned negotiation rules, and the white men ended up with better prices. And there's some question as to why this is, but interestingly, they found that even at minority-owned car dealers with employees of the dealership who were themselves members of minorities, the same effect happened. And so, tentatively at least, the researchers concluded that it wasn't actually racial prejudice in the dealerships. It was simply the dealers figuring, I will only try to rip off the people who are bad negotiators. and they assume that white men are better negotiators than anybody else. So when a white man walks in the dealership, they don't try the rip-off price. They offer a more reasonable price, and they converge quickly on, an appropriate price. Whereas if a member of a group comes in who are, women or minorities, where they figure, okay, these people don't know what they're doing. This is my opportunity to make my profit for the month by trying to rip them off. And that's obviously very, very concerning. It says actually that, as a woman, if you do negotiate, you're doing good not only for yourself, but also you're fighting against this stereotype that women can't negotiate, and you will create an externality, actually, a positive benefit for all the other women who come in later, who will be treated with more respect because, these car dealers will have learned the hard way that women can negotiate too.
Good, and I would say the same goes for pay rises.
Yes,
as well, because moving the top line on the income that we're bringing in. I coach and mentor a lot of different people on how to get a pay rise. It's the most popular podcast I think I've ever done. We sort of redo it every year, and the connection between our emotions and our financial decisions, it's not very scientific or academic, I will admit, but I do find it fascinating. The name of the app that I forgot, by the way, is Snoop.
Snoop.
Yeah,
Okay.
and there's also an app which I've written about, which I also can't remember the name of, but it's only in America, so it doesn't matter. Where it's a dating app, and you can only join it if you have a credit score above 700. Because this is something that is really important. Financial stability is something that people find very attractive in a partner. Now, I have very mixed feelings about this, and I got a very good, well-read 1,000-word column for the Financial Times out of exploring these. But your point about young people being willing to submit their data if they think there's something in it for them is something I think is really interesting. Before we go to questions, because we've got 15 minutes left now, do whack your hand up if you'd like to ask one. I'll just ask the panel one final quick question about education, because I do think that whatever we do, educating people better about finance has got to have a positive impact. Do you have any ideas that you'd like to share with the audience about how best we go about doing that? Who'd like to come in? Tarun?
I'm happy to take. We do talk about this in the book. I think our view on financial education is, as educators, that it's a good thing. As financial educators, that it's a good thing.
More jobs for us, right?
Well, exactly. It's patently self-serving, but we do believe in it. But I think we're both cautious about the limits of the improvements that financial education can generate.
Yeah.
And I think that's really important because there's a number of different reasons for that. The first is that it's, the gap between what we think of as the classroom and the real world is particularly large in very practical applications of this type. Historically, MBA programs have tried to address this using simulations like the case method. Those have been only partially effective. This is the sort of thing which is even more difficult because it's trying to teach people practical, everyday skills that are just hard to transmit. The second thing is that if you're taught something in school, by the time you get out into the position of being able to sort of utilize those skills, they might be obsolete because things are moving incredibly quickly. Yeah. You might have forgotten exactly.
You might be 50 before you get a mortgage.
You might be 50 before you get a mortgage. Absolutely. So that's another issue. And while there is some evidence that financial education helps, the academic evidence on this is actually pretty mixed. I think there's a lot of evidence that you can spend a huge amount of money on it, and if you don't get the design precisely right, which could differ from context to context, from nation to nation, given national context, given the types of people who are receptive to these kinds of messages and so on, that you could actually just end up wasting a ton of cash. So so this is one of the reasons why we advocate shoves, which is we think it's better to change the design of the personal finance system than to try to equip people to function in the current financial system better.
Okay. Kate, what would you like to add?
So I think we need to recognise that there's a lot of complexity, and probably more complexity than ever before, and people need the help. One of the questions is how you can deliver that in a way that's going to be targeted and going to support people at the right moment. So one of the things that we've been doing is a campaign called Invest Smart. So that's targeted specifically at things like Reddit and TikTok and Snapchat and the sorts of fora where people, particularly young people, might be going when they're doing the research of thinking about the sort of investment decisions that we've been talking about. So that is intended to try and help people, support them in the moments when they might be seeking to make a decision like that. So that kind of targeted intervention, I think, has some scope for merit, but it's a complex set of questions, undoubtedly.
So I think there's various ways you can try to do this. It is difficult. Starting with, if you think about secondary education, in the US, gradually, this is a sort of state level thing in the US, more and more states are mandating some financial ed in high school. The risk is it's like, imagine, driver's education without any road component, where you just sit in a classroom and learn about, road signs. I mean, how much will people remember? An alternative that some people are promoting is sort of a higher brow approach, which is to shift the mathematics curriculum in secondary schools in a financially relevant direction. A little less trigonometry and a little more compounding, could really make a difference. And these are sort of fundamental things that if people can absorb would be useful even as the financial system evolves. Another thing I'll say is I'm involved in a movement that's going on in the US now to treat personal finance or household finance as a good topic to teach in colleges. I mean, it was banished for a while. It was sort of seen as something like, carpentry or cooking or something like that wasn't really worthy of tertiary higher education. But actually, there's a lot of very interesting economics in this field, and it can be a good college course. So I'm teaching one at Harvard now, and Stanford's doing one, and other top schools. And so I think that will be useful. And an interesting thing is I find that the most interested students are seniors in their last year who are about to hit reality, and they suddenly realize, I need to know this stuff. In addition, in my class at Harvard, 1/4 of the students are first-generation college students. And they're interested in bringing savvy back to their families. And so I think that's a very good thing. I do think that the kind of providing well-structured, helpful videos that people can see is really important. But the difficulty is you're competing with a lot of these finfluencers who are all, very handsome movie star-like people who are marketing crypto and anything else. And so how do you compete with that sort of unregulated world of potentially bad advice? And it's a tough problem. But maybe putting an FCA seal of approval on certain things is helpful. I think that's a great
certainly
direction
as a content creator, I'm actually at a disadvantage because of the FCA's financial promotions, because I'm not an FCA regulated person. I'm a financial journalist, but you don't regulate us. Maybe you should. I always feel like you do, and that the eye of Sauron is upon me on the podcast. If I say something wrong, but if I want to boost a post, that's considered a promotion. Whereas people who are, even if they've got some kind of like quasi connection to some sort of regulated activity, they can tick that box, but I can't. But that's a moot point for another day. Who would like to do me the honour of asking the first questions? I feel sure they're... Oh yes, I thought I saw your elbow twitch a few minutes ago. Fantastic. Would you like to start us off? And up the...
Paolo.
Up the steps. Thank you. Up the steps. Thank you.
No, directly leading to the last thought, the last performance. So the role of media, I think, is crucial. I see some articles, even on the financial times actually, that are quite upsetting. In Sweden, we have a bunch of pension funds, national pension funds, that every year they get a review on how they did the last year. We know that one performance, they all were diversified, but one performance doesn't mean anything basically. So that's actually a very important topic. How should we regulate it?
How we should regulate the media, or how we should we? Yeah, I mean, it's a separate regulation system in the UK. I mean, I think the point that you make about how the media plays a role in the sunlight of exposing bad practice at companies, whether it's pension companies that have suffered years and years and years of poor returns. I mean, I know I'm a biased person as the only journalist on the panel, thinking that the media is a force for good, but perhaps somebody would like to leap to my defence or otherwise. An uncomfortable silence.
I think I'm not sure if it's the media, or I'm not sure quite what counts as media. But let me give two examples of sort of troubling publicity that I don't know what to do about it. Number one, Morningstar ratings. Okay. Everybody uses Morningstar ratings in the US, and they think this is great. They think it's like looking up a good hotel on TripAdvisor or a good restaurant on Yelp. Well, the problem is Morningstar ratings are very heavily influenced by recent performance. Mm-hmm. Now, there are other things. It's a bit better than that, but the weight on performance that Morningstar places is much too high relative to what academics would recommend. Now, I don't know what to do about it, but it's a problem.
Similar arguments could be made about fund platforms.
Yes. And another example is a very nice paper by John Pan and some co-authors about the presentation of mutual funds in China on the leading smartphone platform. So this is Alipay. Mm-hmm. So you're in China, you have your smartphone, you're looking at mutual funds. The thing will display the mutual funds from top to bottom of the screen in order of the performance in the last year. Now, of course, you're going to have the least diversified, riskiest funds that happen to go up in the last year. They're going to be at the top of the screen. So what do people buy? Of course, it reinforces performance chasing, which is the last thing we want to do. Again, I don't quite know what to do about this.
I mean, I have a sort of similar. So let me put it this way. I mean, I'm a fan of your column. I read it, but it shows up naturally at the back of the paper rather than at the front of the paper. What shows up at the front of the paper? This is
an injustice I've
No, of course, I understand. But what shows up at the front of the paper is housing meltdown, or stock goes up 650% because of they said that they wanted to. So
Elon demands biggest pay deal in corporate
absolutely, history. Right? Yeah. And so the remuneration scheme is that you get rewarded for salient, exciting topics because you want to sell copy. You kind of want to make finance a bit more boring and useful, and it's sort of the structure of the compensation for financial journalism is probably antithetical to that to some degree.
A good point. Do we have any more questions in the room? Okay, we've got one up there, which is I think where the microphone is, and then one down here, and one. Sorry, Tarun, you have one too. Go ahead.
This was very insightful. One of the questions is on the degree of shock. So what you are advocating or suggesting is more muscular governance intervention to make sure that products are cheap, transparent, limited choice, but the choice remains in the hands of the individuals nonetheless. And you had other countries like Australia, where 1 year ago exactly, where you had less choice. In fact, it's all mandatory. You have 10, 11, 12% mandatory contributions. Everything is invested directly in quite diversified products, actually. And when we speak to the Australians, it's interesting, they will say, and we've tried all kinds of things, but what works actually really well is that mandatory, because that we know people save them, saving actually quite decent products as results. And so where do we draw the line here in terms of letting individual choice regulate it or actually doing it for them, at least on parts of their savings?
One of the things we say in the book is that, retirement saving, many countries have decided that, there's wide dispersion, right? There are countries that still run defined benefit, pay-as-you-go pension schemes. Let's put them aside. Let's look at the countries where defined contribution retirement saving is important. Most governments have decided that at least some tax incentives are needed to help people out, to accumulate the money they need to fund their retirement. Once you're providing tax benefits, I think there's a case for restricting the investments. And I think we actually recommend limiting the investments that can be made in these tax-favored accounts. You're getting a government benefit. In exchange for that, you have to give up some freedom. And that, I think, is a natural place to start, because we all agree that retirement security is important, and we don't want to have, destitute older population. So in exchange for some favorable tax treatment, restricting retirement savings to index funds and other low-cost funds. We talk about capping the fees on funds, forcing diversified investment, and so forth. And I'm certainly very open to the idea of mandatory contributions. We don't talk as much about that. That's more out of scope for the book, but I'm sympathetic to that too. Having said that, once you've got your retirement saving in suitable vehicles, if you want to save some more money on the side and do what you want with it, I think we would not want to restrict that.
Okay. Did you want to come in on this, Kate? Okay. We had another question down here and another question over there. The microphone is at the back. It's coming your way.
So this was fascinating. I very much enjoyed it. So three things. First, one of the things I'm currently involved in is actually a project with some German colleagues where we got a bunch of German real people, and some of them are stockholders and others are non-stockholders. And we got interviews to start talking to them about money without prompting them about anything, and really having completely open-ended remarks about what prevents them from holding stocks, or how they appreciate the stockholding, how they run it, and stuff like that. One of the things that came out, not necessarily the most fascinating thing, but it is important, is that they do value this possibility to start small and experiment, and gradually build up, which actually supports your idea of starter accounts and actually these apps, etc. Because they have been bonding to an app that is very popular in Germany nowadays, a trading app, which actually helps them do that. But now I want to ask Kate, the FCA found problems with these apps. So what can you tell these guys, what kind of safeguards perhaps can be put into these starter accounts, or the requirements for starter accounts to prevent the mishaps? That's point number one. Point number two, I want to confirm what Claire said about YouTube videos and all the things that are out there. I want to elevate it one level up. These guys said that they are not just learning from YouTube videos, they feel compelled to watch these videos, because they go out, especially young people, they go out with other young people, and it's like not knowing anything about baseball or football. you know, unless they have watched these videos, they have nothing to talk about. Okay, so there's social pressure to be watching those videos. Now the question is, how do you compete? You know, how does FCA approved videos compete with what is cool, right? That is, you know, that is it. And the third thing, you guys said you're going to put wealth requirements, minimum wealth requirements to participate in risky assets, etc. Politically, how do you imagine this? You know, being able to serve this, you are too poor to be allowed to earn high returns, right? As opposed to maybe you are too poor, so we're putting you in a particular program so that we enable you to earn higher returns. Are you thinking, have you thought about yes?
Do you want to address
Sure.
the third point?
Yeah, I'll take the third one first, I mean, if that's all right. I mean, we already have these qualified investor requirements in many jurisdictions, certainly here, also in the United States. You know, there are some pernicious aspects to this for precisely the reasons that you point out, which is that if you have a very high minimum investment threshold for the highest return products, then you're effectively barring people from doing that. But you know, in some sense, this is not a new idea. It's just, I think we're expanding the set of instruments that we think should come under these kinds of restrictions. Now, of course, the other thing I should just mention is that we don't state this as an explicit requirement that government should restrict people to doing these things. We're saying that government should encourage the financial sector or even mandate that the financial sector always offer a low-cost, cheap alternative every time they offer a more kludgy, high-option, laden, complex alternative.
Okay. Did you want to add something to that? Of course.
Sort of follow up on that. So, you know, in the US, if you want to buy a private fund, might be private equity, might be private credit, you've got to be an accredited investor. What does that mean? You've got to have $1 million in assets, excluding the value of your house, or at least $200,000 of income a year as an individual, or $300,000 if you're married. So, you know, it's a pretty high bar. And we actually think that one might be able to lower that bar if you make sure that people have some basic you know, diversified investments first, right? So, you know, you have your retirement accounts, they're in index funds. Once you've got a certain balance there, maybe that's enough to be accredited. That remains restricted, and you take whatever else you want to gamble with and gamble with it. But the problem with the present system is somebody who's got $1 million in assets can put all of it in any kind of crazy stuff. So in a sense, the barrier is both too high and too low, I think, in the current system.
Interesting way of thinking about it. Did you want to comment on the trading app question? And I have to say, I've never seen the confetti before because I've never used a trading app. I'm horrified by this.
You can see it on, you know, those language learning apps. You get the same sort of
Duolingo.
Like, Duolingo.
Yeah.
So you get it's an owl dances around. I think it's the same sort of.
But learning a language is good. You know, doing a CFD trade is not so good.
So the work that I shared is some work that.
And before we take the final question, I would say, like, on the video point, I think something I should have said that I didn't is what's really, really, really important to lots of people is seeing themselves represented. Now, the financial advice industry, as I'm sure you'll back me up here, it is very pale, it is very male, it's becoming less so and less stale very gradually. But it's really, really interesting that there are so many female financial influencers, even sort of quite plump middle-aged ones have been able to find a little corner of the market like me. But more than that, the number of ethnic minorities who have found enormous, colossal followings. Now, they might not necessarily be talking purely about personal finance and investing. They might be talking about entrepreneurship, starting a business, getting a great idea off the ground, and some of these have, really broken through to the mainstream, which I think is fascinating. It's one of the great democratizing powers of the internet, that we do have these breakthrough stars, and I do interview lots of them on the FT's Money Clinic podcast, and in the newspaper sometimes too, because I think a lot of the time their life experience, what they're teaching us, we can all learn from it. It's not just for that particular community that they might come from, but there's also huge kind of different groups within finance. So parents are another massive group where you've got loads of parents on the internet, not just mums. There are a lot of mums. There's the Money Mum, who I know well, Gemma Bird, and Mummy Penny, another lady who I know very well. And they're all brilliant. But people are able to find a community in a way, that's talking about money, talking about the reality of decisions, navigating the nightmare of the, 7 or 8 different types of benefits that you can get for childcare in the UK that you're supposed to somehow fathom whilst you have this infant that you've got to feed and keep alive. Lots and lots of great things are happening, but equally, there is, I think, a need for greater regulation. The NHS, interestingly, will regulate doctors and other medical professionals who are talking on YouTube. They'll give them like a seal of approval, so perhaps something for the future. But anyway, our final question.
Thanks. Just so yeah, I really like your colleague. I'm a big fan. But not just YouTube following for crypto, is for big world crypto with over 2 million subscribers. Now, we're talking about regulating media, TV, Financial Times, or other newspapers. People don't consume information from there when they want to do this kind of trade. It's YouTube or Instagram or TikTok. Now, the information warfare that we're talking about, the political polarization and all of it, actually serves over the questions of personal finance as well. So just thinking what people understand about how we be able to think and counter this, because you may need a different kind of a shop in the information infrastructure that exists to counter this and that's out there.
I think there's only one solution to this problem, which is that John and I need to get on TikTok. Are you ready? No, but jokes apart, I think that's absolutely right. I think the information questions are really first order. We don't really think about them very much in the book right now, but I think there's a very good case that we need to talk more about this. But I'll leave this to the other panelists.
I would say, for my part, I think that, what we think of as media, legacy media is a term I'm hearing more and more to describe newspapers and TV and radio stations. And then we have social media, but really it fulfills the same purpose. It's all media. The content providers, whether that's the YouTubes of this world or the Googles, the internet companies, really they are now the media companies, but they're not subject to the same kind of media regulation, to the same kind of advertising regulations. We've got the Digital Services Bill going through Parliament in the UK at the moment, and that's taken an awfully long time. It's had all kinds of different amendments added. Regulation is just so fixed often and inflexible and can't kind of adapt to take account of these changes, which is not an answer, but clearly media regulation is something that's needed as well as financial regulation, I would say. How we get the two to work better in tandem, a topic for another symposium, I feel.
one of the things we've been doing at the FCA is working with those other regulators. So we're part of the Digital Regulatory Cooperation Forum, which is with the Competition and Markets Authority, with Ofcom, which regulates online media, and with the Information Commissioner's Office as well, actually, because the digital and the tech space does need that kind of that common perspective and the thinking about it. So that's one of the initiatives that's in place to try to do that.
Brilliant. Okay. Well, we're going to have to wrap up. Do come down to the front if there was a question that you wanted to ask